Welcome, everyone, to what may be the most important investing presentation of the decade. After a 5-year hiatus, Mary Meeker, Silicon Valley's queen of the internet, is back with a 340-page deep dive into the AI revolution. Titled AI Report 17 Stocks to Buy, this deck lays out a data-driven roadmap for capturing a forecasted $6.7 trillion in AI infrastructure spending by 2030. To put that figure in perspective, nearly half, $3.1 trillion, will flow into chip and hardware makers alone. McKinsey projects AI capex will outpace the early internet boom by 5.5 times. If you missed Amazon at $18 or Netflix at $7, today's session is your second chance at the defining growth wave of our lifetimes. First, let's understand why Meeker's report changes everything. In just 17 months, ChatGPT amassed 800 million users. Netflix needed over a decade to reach 100 million. AI inference costs have plunged 99% in 2 years, democratizing access. China installed 290,000 industrial robots in 2023 versus 40,000 in the US. Meeker uses the word unprecedented 51 times because the pace, scale, and cost declines are reshaping every industry. Her warning is clear. The risk of underinvesting now far exceeds overinvesting. Action before the crowd is essential. With that urgency in mind, let's dive into the foundational infrastructure picks, often called the picks and shovels of AI. At the top sits Taiwan Semiconductor, TSM, which controls 92% of advanced AI chip production for NVIDIA, AMD, and Apple. Q1 2025 revenue was up 35% year-over-year as AI demand explodes, and Barclays assigns a $240 fair value target on today's $240 stock price. Think of TSMC as the sole oil refinery in an oil boom. Geopolitical risk with China exists, but their pricing power and capacity expansions make this a must-own core holding. Next is Vertiv Holdings, VRT, which surged 26% in revenue last year thanks to demand for its advanced cooling systems. AI racks generate 10 times the heat of traditional servers. Vertiv's backlog hit a record $7.2 billion, and a design partnership with NVIDIA for 2027 chip cooling cements its leadership. The addressable market here could grow fivefold as data centers proliferate. A hidden gem in cooling is Modine Manufacturing, MOD, a mid-cap with a $6.5 billion market cap and a Zacks strong buy rating. Modine's phase change and liquid cooling solutions are deployed in 37% of new AWS facilities. As hyperscalers race to boost rack density, Modine's revenues stand to climb alongside the AI rollout. Power is the next critical pillar. AI data centers will consume 1.5% of global electricity by 2030, growing at 12% annually, on par with small cities. NextEra Energy, NEE, is the largest U.S. renewables producer and powers Meta's 2-gigawatt AI campus. Constellation Energy, CEG, is leading a nuclear renaissance, signing 20-year deals with Meta and even restarting 3 Mile Island. Bloom Energy, BE, bridges gaps with fuel cell deployments that can scale in months, not years. Each of these utilities combines growth and 3 to 4% dividend yields, offering income and inflation protection. Data center real estate is another backbone play. Digital Realty Trust, DLR, owns over 300 facilities worldwide, pays a 3.5% dividend, and boasts 97% occupancy. Iron Mountain, IRM, is converting its vaults and storage facilities into data centers, yielding 4.8% and leveraging lower build costs. As AI workloads multiply, these REITs raise rents and expand margins, delivering stable recurring cash flow. Once the hardware is in place, AI layer stocks turn infrastructure into solutions. Palantir, PLTR, saw commercial revenue jump 45% year-over-year and just won a $795 million U.S. Army contract, proving its AI platform's government and enterprise utility. ServiceNow now powers AI-driven workflow automation for 85% of Fortune 500 firms, sustaining 20+% annual growth on a subscription model with rock-solid retention. Palantir offers high-risk, high-reward exposure. ServiceNow delivers a stable recurring revenue foundation. Physical metals like copper and lithium are the unsung heroes of AI build-outs. Freeport-McMoRan, FCX, is the world's largest copper miner, with a 3.2% dividend yield and supply disruptions in Peru, driving higher prices. Copper demand triples for AI data centers. Albemarle ALB ranks among the top lithium producers. Although its stock is down 60% from highs, surging battery backup demand for data centers makes it a long-term turnaround story. Artificial intelligence's third pillar is robotics and automation. In healthcare, Intuitive Surgical, EISRG, dominates with the Da Vinci system, capturing 80% of the market and generating recurring procedure-based revenue. Industrially, ABB Limited, ABB, ranks number 2 globally, benefiting from manufacturing reshoring and boasting a 2.5% dividend yield. Both companies are integrating AI to boost efficiency. When China installs 290,000 robots in a year, these names lead the charge. For speculators with high risk tolerance, MEEKER'S report points to moonshots in quantum, delivery, and cloud infrastructure. IonQ won a $600 million DARPA contract to advance quantum training of AI models, albeit with $220 million in annual cash burn. Serve Robotics, SERV, partners with Uber Eats for last-mile delivery robots in major cities, forecasting 51% earnings growth as they scale. Nebius Group, NBIS, offers a niche AI cloud alternative, tripling revenue in 2024 through partnerships with NVIDIA. Allocate no more than 5 to 10% of your portfolio here, but these could redefine computing, logistics, or data hosting paradigms. With these building blocks in place, MEEKER recommends 2 portfolio frameworks. For conservative investors aiming at 15 to 20% annual returns, allocate 30% to TSM, 20% to clean and nuclear power, NEE/CEG, 20% to data center REITs, DLR/IRM, 15% to cooling, VRT, 10% to copper, FCX, and keep 5% cash for flexibility. For aggressive growth seekers targeting 25 to 40%, shift allocations, 25% to cooling, VRT/MOD, 20% to software, PLTR/Now, 20% to power, BE/CEG, 15% to robotics, ISRG/ABB, and 15% to speculative moonshots, IONQ/SERV/NBIS. Execution matters. MEEKER urges a quarterly rebalance guided by 5 key metrics: big tech capex trends, data center power consumption, AI inference cost declines, industrial robot installations, and exchange supply changes for Bitcoin. Her bonus slide! Start with infrastructure leaders, layer in power, add software post-earnings clarity, and sprinkle in speculation up to 10%. Review position sizing and sector weights every quarter to stay aligned with the AI market's rapid evolution. Of course, risks abound. High valuations can lead to sharp corrections if growth misses expectations. Regulatory shifts around data privacy and carbon rules could slow expansions. Geopolitical tensions threaten supply chains and chip making. And rising power grid constraints may bottleneck data center builds. MEEKER'S caution: infrastructure plays carry lower execution risk than pure AI application builders, but no investment is bulletproof. We stand only in the second inning of a decade-long AI cycle. From 2025 to 2027, infrastructure will deliver the market's biggest gains: chips, power, cooling, real estate, and robots. By 2027, these winners will be widely recognized and fully priced in. The question isn't whether to invest in AI infrastructure. It's whether you'll act before the crowd catches on. Want the inside scoop on my AI stock playbook? Subscribe to my Substack to access all my top AI picks, detailed entry points, and portfolio templates for conservative and aggressive strategies. Details are in the description. Leave your pick in the comments and hit subscribe so you don't miss next week's deep dive on position sizing and risk management. In a world reshaped by artificial intelligence, the builders of the backbone will mint tomorrow's millionaires. The window is open. Let's build your AI portfolio today.